Aloha, everyone. Joshua Hayes at BigWaveTrading.com. Well, if you've watched the last 2 to 3 weekend video lessons, you know that I've been warning about the negative divergences building in multiple areas of this market while the SPY and QQQ makes it to new highs. Well, finally, we all know that options expiration has a tendency to be a negative day, but really it's the day after, the Monday after. And that Monday after options expiration on Friday happens to line up with the worst seasonal period for stock market returns going back to 1950 in the S&P 500. And from July 17th through September 27th, there is no more rolling bearish period in the market going back to 1950. And just to let you know what it looks like for the rest of July, today is Sunday, and thank God the market is closed for those that are really long this market because it has an average annual return from 1950 of negative 28%, which is followed by negative 1% day on the 19th. On the 20th, it's negative 11%. The 21st, negative 40%. 22nd, negative 12%. 23rd, negative 35% on an annualized basis. So, be prepared for a rough week seasonally. Doesn't mean we have to go down. We all know we can continue to melt higher. But I want to show that there's just negative divergences building everywhere out there. Our focus remains intraday. On Friday, I had to leave early, but I lined up an amazing SPY put idea for everyone. And you can even see the Fibonacci retracement levels are here. I just want to let everybody know around here, right before I left, I told everybody look for a rally in the SPY back to VWAP and the 38.2 Fibonacci retracement for SPY puts. Gave the expiration, gave the date to use, or gave the expiration, gave the strike price to use, and SPY from that moment of failure to the lows, that option moved 90% intraday. So if the market wants to sell off, we will continue to focus on SPY puts, but we're also continued intraday to focus on the small cap longs that are in play every day based on catalyst event, blah, blah, blah. Always looking for high R-vol. Wherever the gamblers are focused, that's where I want to be. But for now, on an end-of-day basis, swing trading wise, I'm still taking new long positions as they trigger, but max on any of them unless the signal is great. And if you want to remember what a good signal looks like, EVC on this day wouldn't be considered great, but it was close to being great. And as we all know, from the entry price to the highs, we got a 70% plus move in a little over or about a 1 month time period. So until I get that signal, I'm still willing to take trade ideas, but I'm only going to be risking 1R max loss from the entry to the stop until this market trades a little bit better. So SPY, we're seeing the TTM trend momentum is finally flipped on Friday, but the PPO is still over the zero line, so there's no reason to get too bearish too quickly. The DIA, same thing. There's no reason to get too bearish. But the QQQ, that got a little overbought, not too bad. We see the PPO actually flipping to a negative. We'll look at that further on, but the biggest problem continues to be the IWM. I'm a small cap trader. This is my area that I focus on. I do admit that I need to be more diversified and learn to focus on the large caps and play them off the 21 EMAs when they're in squeezes, whenever they do set up. But small caps has always been my area of interest. For the end of day swing side, the quarterly portfolios that I run really focus on the big caps. And if we look at the IWM, it's looking real bad. So on these charts, you can see nothing squeezing. There's no gray, red, or even yellow dots on any of these charts. So there's not a safe entry zone. And with the negative seasonality coming up, I now want to show you what I want to warn everybody about. You can, like I said, go long a market here, but I'm heavy cash in my end-of-day swing account, and my quarterly portfolios is only operating at a 50% level. In Q4, we'll go back up to 100%, but right now with the market conditions, cash is king. But before we wrap up this video lesson, because we're making it quick this weekend because there's no new long positions I want to discuss, there is a hedge I'll give out to everybody. So when I talked about that SPY put option that moved 90% intraday, puts are in favor whenever there are no stocks in play intraday. But on a swing side right now, I'm looking to put on hedges. I have quite a few on, and come Monday, I plan on having more. I'll go ahead and give out a trade idea at the end. But first, I want to show you what the market looks like and what the internals look like that I track on stockcharts.com. Okay, higher here, but what I want to show you basically is you're looking at the SPY. You can see the RSI, there's negative divergence before price rolls over. On top of that, the MACD and PPO is crossing its moving average line. Doesn't mean it has to stay that way, but just want to let you know, whenever it crosses down, every time it's crossed down recently, not here, notice that the cross is late, but every time that it's like a slow roll cross, the SPY ends up pulling back. We have a fresh cross here. Now, why do I think any kind of pullback at some point is viable? Look at the accumulation distribution line. That's bullish. So the next one I want to look at is obviously the QQQ. Same thing. Negative divergence in RSI near the highs. We're rolling over. RSI is cracked. MACD is cracked. PPO is cracked. How's the accumulation distribution line look? Pretty good. So once again, not too bearish here, but definitely short term, at least probably into September 27th. Listen, if the market wants to do a follow-through day before then and I have proper setups, stocks have cleaned out, look like they've washed out, sure. But right now, while we're in the heart of some really bearish seasonality, and I want to remind everybody, August and September are historically the two worst months seasonally in the S&P 500 1950. So, I mean, you're fighting a lot of, you know, we got seasonality, now we got price confirming. So just be careful out there, everybody. That's the whole point of this video. But the DIA, same thing. Look at how bad the divergence in RSI is. Still looking good on the MACD, PPO, and accumulation distribution line. So out of all of the indices, the most narrow index of 30 stocks is what looks good. Still, don't know how much longer that's going to last. And then more importantly, my index, the IWM, it looks ugly. We're still not oversold yet on the IWM. So if you're looking for an oversold bounce, we're still not there in the RSI. MACD and PPO is really declining. Histogram is really confirming. Until you see that curl back above those lines, I would be really careful about trying to catch a bounce here until that RSI does hit 30. And trying to catch a falling knife is not my idea of a long-term sustainable methodology. Accumulation distribution line is weak short-term, but overall not bad. But the most important lines I look at, so I look at all of these indices, right? We see how the DIA looks. We see how the QQQ looks. We see how the SPY looks. We know what the IWM looks like. Now what I want to look at are, let's do this, the advanced decline lines and the advanced decline volume lines. This is the Dow Jones Industrial Average. Nothing too serious here. Look at the mid-cap advanced decline line. Okay, we got confirming signals there. Confirms the weakness in IWM. Look at the NASDAQ advanced decline line. Do you remember what the NASDAQ looked like? Compare that to the advanced decline line. There's some real weakness in the broader stocks. Here's the NDX advanced decline line, even the NASDAQ 100. Starting to roll over to lower lows short term. It's looking pretty weak. Look at the MACD and PPO. I forgot to bring those up for all of these. You can see that they're all heading in one direction. Keep moving down. New York Stock Exchange advanced decline line. Same thing. Weakness. Weakness. NYSE common stocks only. Weakness. Think about where the SPY and QQQ are on their dailies that we just went through. Think about all these. Here's the OEX, S&P 100. Not too bad. But still, once again, a very narrow number of stocks. S&P small cap advanced decline line. Yikes. S&P 500 advanced decline line. Not bad, but not good either. We do have lower lows. The advanced decline volume line of the Dow Jones Industrial Average. Well, we know that the DIA has made higher highs from this level, or is about appropriately caught up to it. I can't actually remember. Let me go look at my other monitors. DIA, yeah, it's actually a higher high, so that's negative divergence there on those highs. Last page, then we'll go look at the one hedge I want to go over. Mid-cap advanced decline volume line. Not good. Lower lows. NASDAQ advanced decline volume line. This one looks better, but still, short term, lower lows. NASDAQ 100 advanced decline line looks a little better, right? Stronger, obviously, with the NASDAQ leading, but still, short term, lower lows. MACD PPO rolling over. NYSE advanced decline line, lower lows, not looking good. NYSE common stocks only, lower lows. S&P 100 advanced decline volume line, lower lows. Starting to get the picture, lower lows. Lower lows, SPX advanced decline volume line. So that's it for that. So remember all of these lines, what they all look like. Scrolling back up for you guys. These are advanced decline lines, the advanced decline volume lines. Look at what they look like. You'll notice that they've never really cracked like this before during the uptrend. Notice the higher lows, and then here even kind of even. Now we're starting to roll over, so just keep all that in mind whenever you then look at these index charts. All negative divergence. DIA moving up, but I showed you all those advanced decline lines. We saw the MACD, PPO still good on the DIA, but on the SPY, showed you all those advanced decline lines, advanced decline volume lines, PPO, MACD, QQQ, showed you all those advanced decline volume ratio lines, short term, higher lows, lower lows on all those indicators, showed you the MACD, PPO. Starting to get a picture here. A lot of negative divergences. Doesn't mean it has to lead to a sell-off, but if you ever want to know a time when to be really long and strong in this market or not be long and strong in market, now is it, especially as we head right into the most negative seasonal period for stock market returns. So now let's just look at one of the hedges that I'm adding to my current holdings of hedges. I said I've already added hedges on the end of day swing side, still have some long positions out there, and those long positions, they've been working and then they're giving back their gains. I rarely let these things go red on me, but I still give them a chance to work out to protect in case the market does fall apart and those long positions do reverse hard. That's what these hedges are for. And if the market continues to sell off, my profit stops or sell stops will be hit. Take my gains, minimize my losses, and then we'll let the gains run with these hedges. So one of the hedges I'm going to put on Monday is TECS. It's a technology bear tripled up. So what I'm doing, I see a hammer or a candle over candle pattern, building volume, heavier above average volume, and today's volume bar is a pocket pivot point signal. The last time it got pocket pivot point signals here, you can see it ended up going in the right direction that we wanted it to go. We also have BOP increasing from the previous day, a nice, decent green level. So TECS is simple. The high day is 45. My good to cancel buy stop will be at 486. I'm going to add 5 cents for a 1% limit offset. So 486 stop, 491 limit, and I'm willing to risk all the way down to 450. So what I'm going to do is take 486 minus 450, get that total, divide into 1% of this end of day swing trading account capital, and that will be my position size with TECS. It is liquid enough for me to do that. Now, if TECS fills on Monday, and let's say that the Monday low day is 480, I'll have a stop at 479. I'll have a stop at 458 and a stop at 450. By doing that, it prevents a full 1R loss. So that's it. That's my trade idea heading into Monday. By the way, if it opens, let's say at 475 and fails this low before triggering to the upside, it's the trade is canceled. So let's say that it closes below 450 before triggering at 486, trade is canceled for what it's worth. All right, everybody. Have a wonderful rest of your weekend, and I wish you all the best during this upcoming trading week. I'll see you next weekend.